What are we doing in this paper? We build on the framework by Holmstrom and Tirole and develop a tractable and flexible framework to analyze the system-wide effects of capital requirements. The features are: firms are heterogeneous according to the risk dimension, their NPV, and whether their investment requires a bank loan or not. There are going to be two types of financiers, banks versus public markets. Banks have a monitoring skill advantage, so that gives them a social advantage. A subset of firms requires loans to be made by banks to actually make investments. Now, banks don't just have a social advantage in our framework, they also have a private advantage. The private advantage is they can raise underpriced deposits due to deposit insurance. More generally, think about bailout guarantees. This allows them to have a private advantage and potentially compete unfairly on particular firms. To tame risk-taking incentives, banks are subject to regulatory equity ratio requirements. Think about Basel I to Basel III. They may raise additional costly equity capital if they find that profitable. Finally, our framework allows for signals of loan risks. You may think about ratings, it doesn't have to be ratings, that set risk weights for particular firms. Our model yields an endogenous segmentation of the banking sector along leverage and portfolio dimension. Loan prices ensure that risky banks do not want to hold safe debt because the price is too high for them, and safe banks do not want to hold risky debt because the price, again, is too high for these safe banks. The idea is a risky bank defaults in some states of the world. They don't care about cash flows generated in the states of the world where they default. And likewise, a safe bank does not benefit from the regulatory put, and as a result, would not want to engage in risk. This yields to an alignment of bank default states and asset state payoffs, and may actually be a good representation of what's going on in Europe right now. Our second set of predictions revolves around the effects of equity ratio requirements as you increase them. The important part is that it depends on the initial level of bank equity. If there's a high level of existing banking equity sector capital, an increase in equity ratio requirements leads to a reduction in inefficient risk-taking. Banks have better incentives and make better investment decisions. Now, when the banking sector equity capital is sufficiently low, you have an additional effect. You obtain credit rationing because banks cannot fund all profitable investment opportunities. What you then obtain is credit rationing of two types of firms. The first one is bank-dependent firms that have positive NPV projects, but banks are constrained to actually give them financing. And the second part are firms with risky negative NPV projects. Of course, these are the types of firms that shouldn't be funded. Now, as you can see, part A, a reduction of financing of firms with positive NPV projects, that's going to be bad. A reduction of financing of firms with negative NPV projects is going to be good. So depending which credit rationing is going to be more important, the welfare effect can go in either direction. What we're now trying to do is give you a brief graphical illustration of the model mechanics. So consider two equiprobable macrostates. We call them L and H. Many firm types with state contingent cash flows, which we label CL in the low state and CH in the high state. And we're going to consider a special case of the model. So for now, firms are cashless, and they have the same threshold for public financing. If you want to think about the Holmstrom-Tirole 1997 framework, what that means is all these firms are subject to the same agency rent. Also, I'm going to make the assumption for now that bank loans to all firms are subject to the same equity ratio requirements. They all look alike to the regulator. Moreover, assume that the amount of equity that the banking sector has is not large enough to fund all firms. They require some deposits to finance all these firms. And just for simplicity, initially assume that the outside equity raising costs for banks are prohibitively high, so there's no equity raising. So to understand the structure of our analysis, we're going to proceed by showing the following graph. On the x-axis, we're plotting the state contingent cash flow of a firm type in the low state. And on the y-axis, we plot the state contingent cash flow in the high state. A particular x refers to one particular firm type. Since we normalize the investment size to 1, all firms above the black line are going to be NPV positive. Now there's a second set of line, which is the set of firms that have access to public financing. In this example, we assume that all firm types have the same threshold. So as a result, all firms that are above the blue line are going to be having access to public financing. Now, as you can see, ideally we would want to have the banking sector finance all firms that are in the corridor between the NPV 0 line and the NPV equal B line, or put differently, the banking sector should fund all NPV positive firms that require bank financing, and the remaining firms could be funded by public markets. Now there's a third line, and the third line indicates the set of firms that the banking sector wants to finance, that the banking sector finds privately profitable. In the first example, we set equity ratio requirements to 0. Because banks want to engage in risks in this extreme world, banks may actually want to finance a firm that offers a low cash flow in the low state, but a sufficiently high cash flow in the high state. And this firm that I just indicated is an NPV negative firm. So what you obtain is overinvestment. So what we're now trying to understand is what happens to the financing decisions in the economy as we increase equity ratio requirements from 0 to higher levels. Let's first look at the set of profitable investment opportunities. When the capital ratio requirements were 0, the set of profitable investment opportunities was everything above pi equals 0. Now as you increase equity ratio requirements to 10%, bankers have to put down part of their own money to fund investments. That means that some of the firms that were just done for risk-taking purposes are no longer worth financing. And as you can see, the incentives of the banking sector becomes more aligned with the social line, which is the NPV equals 0 line. As we increase capital requirements from 10% to 30%, you can see even a better alignment of incentives of the banking sector and society. However, there's a big difference between the case of capital ratio requirements of 10% and the case of capital ratio requirements of 30%. In the case when capital requirements are 10%, the banking sector can fund all privately profitable investment opportunities. Put differently, given their equity and the equity ratio requirement, they have sufficient funds to fund all these firms that are above the pi equals 0 line. And as a result, we don't have any credit rationing. That also implies, if we go from 0 to 10%, there's going to be only a positive effect of capital ratio requirements. We have eliminated a few risky NPV negative projects that are no longer financed, and we've reduced overinvestment. Now, as we move from 10% to 30%, the banking sector is constrained in financing all firms in the economy. Again, the reason is the banking sector has a fixed amount of equity. Now, as you require higher equity ratio requirements, the banking sector has less funding capacity. And what's going to happen, he will drop the borrowers that are least profitable from a profit maximizing perspective. So this is important. The banking sector does not necessarily drop the firms where the banking sector has the lowest social advantage. The banking sector just thinks about the profit. So what the banking sector now drops are firms that are NPV negative and risky, and firms that are NPV positive and require bank financing. Now, as you can imagine, the welfare effects depend on whether a lot of firm types are in this region here, which you can think about small to medium-sized firms that require bank financing. They have small NPV positive projects, but they're not going to be financed by banks anymore. Or whether the economy features a lot of risky NPV negative projects. And as you can see, an increase from in equity ratio requirements from 10% to 30% may actually be welfare decreasing. Now, one may wonder what the effect of additional equity raising would be. Now clearly, in this panel 1, allowing for costly raising of equity would not do anything because the banking sector can already fund all investment opportunities. Likewise, when the capital ratio requirements are at 10%, there's really no point in raising additional equity capital because the banking sector can fund all the investment opportunities that are profitable. So the only panel that is relevant to understand whether there's an incentive to raise additional costly equity capital is panel C. And the reason is, in panel C, we see credit rationing and potentially profitable investment opportunities. So let's see what's going to happen if we allow the banking sector to raise additional financing. What this graph plots here is that the additional firms that the banking sector now finances with the additional equity raised. The interesting part is there are going to be 3 types of firms that are going to be financed. The first one is the banking sector will raise new equity, lever up on the new equity, and start financing risky NPV negative projects. This is an exacerbation of overinvestment. The next part is, well, they will raise new equity, lever up, and finance good, safe, NPV positive projects. That's a good part, reduction of underinvestment. The third effect is the banking sector will crowd out public markets. That means for a subset of firms, the banking sector will now lever up, will undercut the loan yield that public markets are willing to provide because the banking sector has access to subsidies that the public markets don't have. And as a result, you see these crowding out effects. So that the banking sector may actually finance firms where it has no social comparative advantage, namely those firms, whereas some of the firms where the banking sector has a social comparative advantage, these red firms here, are not going to be financed. What are going to be the implications of our analysis? Let's first consider the implications of our analysis with regards to public markets. So first, there's going to be a long-run trend that public markets have become more efficient over the past 50 years. Now, that also means that banks play a smaller social role. Or put differently, risk-taking delivers a larger portion of bank profits. Just to give you an example, deregulation in Japan allowed firms to bypass banks. Now, as a result, banks engaged in more risk-taking. And what would be the optimal regulatory action in our framework? Well, you should increase equity ratio requirement. Our paper has a cross-country implication, which is that as the development of public market differs across countries, capital requirements should be, for example, higher in the US, where a lot of firms have access to alternative financing sources, versus in Italy, where most firms are in this region where they need bank financing to actually finance investment. Our paper also has cross-sectional implications for the setting of capital ratio requirements. Different types of firms have different types of access to public markets or alternative financing sources. The immediate implication is one should not just think about risk weights when setting capital requirements, but these risk weights should also incorporate whether the firm actually has public market access or not. In particular, small and medium-sized firms should have probably lower risk weights than a firm with a similar cash flow distribution but access to public markets. And the reason is that banks can actually create more social value for these types of firms. Let's summarize. We develop a tractable framework to analyze the system-wide effects of capital requirements. Key ingredients are that firms are heterogeneous according to the cash flow distribution and their access to public markets. The robust insights are as follows. There's going to be a segmentation of the banking sector to optimally extract these public guarantees. And this is consistent with banks holding the debt of their own sovereign above and beyond a home bias story. The segmentation also implies that you don't want to look at an individual bank. The relevant comparative statics must occur at the banking sector level. With regards to capital requirements, we find that they increase welfare as long as aggregate banking sector capital is sufficient. If it's not, it is unclear which firm types get credit rationed, and you may actually hurt the economy.